Hello traders, Gary Wagner here. Approximately 10:45 in Honolulu, making it 3:45 in New York. It is Tuesday, the 29th day of January 2013, and this is the daily report for gold and silver. Nice showing in the precious metals markets, across the board trading higher today. As we look at our gold chart, you can see 1663.5, let's call it 1664.5 bid ask spread, putting it up about $9 on the day, or over 0.5%. It's had a low of 1658, and we are just shy of the high, which is 1667. No doubt silver is shining today, up almost 2%, actually up about 1.78%, 55 cents on the day. As you can see, current print is 31.38, 31.48 bid ask spread. As I said, up about 55 cents with a low of 30.88 and a high of 31.57. This report is coming just following a trade recommendation which we sent out to you. Of course, this video will probably air about an hour, 2 hours after that, but I want to give you a sense or a feel for what I was looking at, what issued the signal specifically. I put in a target area in terms of an exit for that trade, and I kind of want to define why I believe that that is a logical or good place to look to exit the trade. But let's start by looking at the short-term 60-minute chart. When we do that, it becomes quite clear that as this market moved up, and this is what I believe is our wave one, this is all found within, of course, our intermediate three, we hit this top, 1700 couldn't be taken off, we started to slide. That gave us an indication that we were in a corrective stance. However, typically on any kind of corrective stance, your first wave down typically will go to 38 or 50%. And this one was a little drastic. It went all the way to and below, as you can see, 61.52, which is our 61% retracement. And it's a retracement of this, of course, this rally up here. And it appears as though, at least on a tentative basis, and we have an alternative count that I talked to you about yesterday, but I'll show you how both of them actually match in terms of our target of exit, whether we're seeing an ABC, whether we're seeing a channel down, or whether it turns into a compression. These are the things that can unfold, and we want to be able to look at all those scenarios to make sure that our strategy, at least our strategy, is sound. Now, you see, of course, that the market itself did dip below it, dipping down to just below 50. And as the market came down, it absolutely found some support right in this area by virtue of the spike up. Again, this is a 60-minute chart. You can see it kind of goes straight up, and then at this 50%, which is 1661, it kind of starts going a little bit sideways. In other words, it's been trading in this area for a while. Now, in terms of my target for exiting the trade, it's straightforward Elliott wave modeling, and let me show you what I mean. So again, a 60-minute chart, Henkin format, Japanese average format, and simply what we've done is put in an additional Fibonacci retracement. Of course, this first retracement is simply from the beginning of one to the conclusion of one. This is the entire rally. And as you can see, this first wave took us down to precisely or right in the area of 61%. Now, on an A, B, C type correction, you will typically get the market coming down. This is your A wave. Your B wave is typically going to be anywhere between 50 and 75% that of the original A wave. And therefore, on the B wave, we're looking at a move to either 1673 as high as 1684. This is our target. And of course, our target is based on 75 and 50% in terms of the price move itself. Now, let's assume, as I said, we talked yesterday about the possibility of a downward channel. Even if that's the case, it still holds within our parameters. And let me pull up a different chart to kind of show you what I mean by that. And to do that, we want to look at the same chart we looked at yesterday, which in essence is a 480-minute Japanese average chart. Now, looking at our downward channel here, And these are our channel lines right in here. If in fact the way this unfolds is really a 1, 2, 3, 4, 5, something like that, we're still within 4. So just as you see the market move back up here, there could easily be a scenario in which it goes back to test this area here. And if we basically look to see where they would intersect, it would be right around, call it 1680. So if the market would move back up and find resistance at this upper level of a channel line, of course, we would be okay. Where we would get in trouble, of course, is if the market had a short clip up and then move back towards this lower channel line. That's what we want to pay attention to. However, it is my belief at this point, in the way that it held at that 61%, because of the strong level, really, of support that we got in this area, I'm really looking at this unfolding again as a B, C correction, with C either being a flat, or the lowest of the areas would maybe be the 76%, which is 1643. Of course, a truncated C would be anywhere above 1653 after moving up. So we'll have to take a look. This is going to be a shorter term trade because we're not really looking to capture a longer term trend. That being said, typically I will look to trail stops behind the market, and what we really give up when we trail those stops behind is if the market move is in terms of time sequence and price move, is a fairly short move. Of course, we're only capturing about 30 or 40% of that move. By looking at a upward target and looking to get out in this area, we would capture more of that move. And absolutely, when we look at the market trading 1662, 1663 bid-ask spread, what you'll see is that from 63, 73, 84 is about a $20 trade. So it's not a major trade, but we do want to see if this market wants to move higher. And if it does, we want to be positioned accordingly. I also spoke about only putting in half of the equity you would normally trade with. In that way, we have a little bit of flexibility where we can buy on a dip or buy on a breakout or have less exposure if the trade, of course, goes south. You know, as we've watched gold break out and really trade in an aggressive manner, really, when we take a look back, I kind of look at the Super Bowl run starting between 2006 and 2008. Really what I'm looking at is the beginning of this huge spike up, this rally, which started at about 700, end of 2008. However, there is one thing that seems to be a continual occurring pattern within gold. You can see just prior to this breakout to the upside, again, you had this kind of a compression come into the market. There's no doubt right after that the market goes sideways and then really trades straight up. You can see that again right in here, just prior to a breakout. And you can see how the market itself has formed really pretty strong compression triangles as it consolidates and moves back up. Here's that triple top that we got right around 1400 at the end of 2010, 2011. And of course, this tremendous compression triangle that we've gotten just recently. And that also can be characterized with this descending top and this flat bottom. Now, why do I bring that up? Because although it's on a smaller scale, it does appear that what we could be looking at also is that same type of activity kind of almost repeating itself, whereas here we had kind of a flat bottom and a descending top. And again, here we're getting that descending top. And it seems as though these descending tops tend to come just prior to major breaks within the market. And that's one of the ways you can characterize a market that is moving higher. Gold is quite unusual, but really there, to me, seems to be some historical data. Really, the two areas that I believe are very, very close. One right in here, if we compare that to this breakout now. And then if we look at this current breakout in a larger sense, meaning if we look at these series of tops like this, we could be forming just a major break to the upside, and we're going to need that if the market actually can get over 1800 and even test this record top. You know, there's periods when the market's under extreme pressure that we question whether or not this bull run is still intact. My answer to that is I truly believe there's some distance to go in this long-term rally in gold. Silver, quite interesting. You know, as we've talked about in many occasions, there is no doubt that silver outperforms gold in terms of percentage gains on the way up and outperforms gold in terms of percentage losses on the way down. One of the things that we note, we're looking at our daily silver chart, continuous contract off the COMEX. When we saw this rally, and this rally really was from what, about $29 to 32, a $4 move. When it came back down, it seems as though it found some support just below 50%. But then take a look at this. This is the following day, meaning today's trading activity. It opens right at that 50% mark, goes right through 38, trading well into that area at 31.40. And this is showing us extreme support in that area. So in the same scenario in terms of what we're looking at, this being wave one, and then when we look at this as our really our corrective phase, we would have our A here, our B, and then of course following this B up, we would probably get one more corrective wave, or our C. C could take us as low as 30, 47, 61%, and as shallow as really back to 50% if it's simply a flat. Now, in terms of looking for an exit strategy, we would look to do a very similar study to what we have done with the gold market. In other words, if what we're looking at is this is our A wave right in here, then it is a good model in terms of just straight Elliott wave strategy to basically take a look at a scenario in which the move up would be anywhere between 50 and say 75% of that move that we saw in A. So let me go ahead and get rid of the other fib retracement areas. I'll keep this at 76. Let's move this forward, and let's put our text in here. And so what you'll see is, in fact, let me move the text to the other side so it doesn't really confuse us. In terms of a target or a strategy to where we think it could go, we would look for this market to test anywhere between, call it 3160, all the way up to about 3207. I believe that we're going to find some decent resistance really at this top here. We could find a little bit, but there's really, in terms of historical data, there's not a lot of precedence, because as you can see, this market pretty much, when it fell pretty much straight out of bed. So there's no real areas that we can look at. So we'll simply go with, as I said, our straight Fibonacci model, and if I simply remove that, we'll get a better indication because we can unconfuse ourselves here. But these would be the target areas that I would look for on this particular trade. Call it about, on the high side, about 32. So again, if these trades work for us, and I believe that they will, these are going to be, in terms of market time duration, much shorter trades if we are in fact just within an A, B, C correction and we're playing this corrective wave to the upside. This has been Gary Wagner, wishing you great trading as always. We'll talk to you tomorrow on Wednesday for another daily update and review. Bye-bye.